Welcome to the overview of Chapter 10, Chapter 27 in the text, as we look at aggregate supply and aggregate demand. Glad you're here to join us for this overview. And again, pause the video in spots if you need to delve into more information and take a closer look. That's what it's here for, and we hope you find it helpful. All right, we're going to start by looking at aggregate supply, this idea of an upward sloping aggregate supply curve. It's the relationship between aggregate price level and the quantity of output. We look at this as real GDP in terms of that aggregate supply. Notice that it is price level, not price, and instead of quantity, it's real GDP because it's the yield in a year that contributes to the overall production of final goods and services produced in a country within a given year that is not including inflation. So real GDP would be what we normally would look at there. So think of it in those terms, the idea of what an economy can produce within a year at different price levels. And that is essentially going to be your aggregate supply curve in the short run. That short run aggregate supply, or SRAS, is the idea there that includes that upward sloping as short-run aggregate supply curve, and that's because wages and resource prices are sticky. The idea is they're not going to change just because price levels are rising or falling. They're going to stay stuck there in the short run. And the reason for that is because obviously people don't switch jobs when prices go up, and they don't switch jobs when prices go down, and so that's the reason for the stickiness. Now, in the long run, wages aren't sticky any longer, and everything is flexible, including those getting other jobs, and so that's what we see here in terms of differences between short run and long run when it comes to SRAS or LRAS. In this case, short run aggregate supply, SRAS, or long run aggregate supply, LRAS. The idea of it being sticky is because, again, the employees that are working are going to end up paying more for goods and services they get when prices rise, and they're going to more out of their pocket in terms of the dollars in their pocket are going to, it's going to cost more of those dollars. They're not getting any more of them, but it's going to cost more of those dollars in terms of purchasing power, and less, obviously, if prices fall, which we know that isn't as common as the other way around. And so that's what we see here, this idea of a nominal wage that is paid because inflation is involved in that sticky wage scenario. Now, by sticky, what do we mean by that? We mean that it's slow to respond to changes in the market. The idea is there is a slowness to that stickiness, and that the stickiness doesn't last forever. The nominal wages that are there, maybe they're priced too high or priced too low, that will ultimately be offset with changes in terms of people taking a pay cut or people losing their job, and they hire other workers, new workers for new positions or other jobs at lower costs along the way. Or maybe they have to pay them more if the prices are rising. But that's what we mean by sticky wages, and the idea of that slowness to respond to changes that we see there. Now, we saw one of these anomalies in 1929, the difference between real GDP here. Taking inflation out of the picture, we can see there was no growth between 1929 and 1933. You had a real GDP that was actually shrinking, and that is based on historical context. That makes a lot of sense because we had the Great Depression in which people weren't working. When 1 in 4 people are out of work and the economy is hurting, you're not going to have a lot of people producing and growing your real GDP. So this is the one time in history where we see real GDP is actually falling. And we can see that evidenced here from 1929 to 1933. The real GDP is actually less in 1933 than it was 4 years prior. And that's a really good indicator of what we call there the recessionary gap. The idea that prices are falling, the aggregate price levels are falling, and real GDP is falling too. That's a recessionary gap that has been developed there in terms of where we were in 1929 and where we are in 1933. The upward sloping supply curve, again, the idea here as price level goes up, law of supply tells us that the firms are going to produce more because they want to make more money. They have an incentive to profit from that particular transaction. And we can see that real GDP grows as a result of those price levels rising as well. Now, with SRAS, we can have shifts in SRAS moving leftward or inward, rightward or outward, based on some factors that we'll talk about here in a second. But the idea is when we're looking at an SRAS that is decreasing, that's essentially that leftward or inward shift. When SRAS is increasing, that's the idea that the SRAS is shifting rightward or outward in terms of real GDP growing in that respect. Leftward in terms of real GDP shrinking, like we saw in the 1929 example. So what shifts SRAS then? What shifts this aggregate supply? Well, IRAP is the mnemonic that we use here in order to address a shift in short-run aggregate supply. And this includes inflationary expectations, the resource prices, the actions of the government, which would never include spending because that's aggregate demand, and then productivity changes. So let's look at each one of these. Inflationary expectations is the idea that if consumers are expecting lower prices, then SRAS is going to shift rightward or outward. The aggregate demand is going to move along the curve to a lower price level and a greater real GDP. Resource prices. If the prices of resources, inputs, actually rise, that's going to shift short-run aggregate supply inward. If the resource prices fall, that's going to shift SRAS to the right. Actions of government, such as, and again, this is for producers. So if you're lowering taxes or raising taxes on producers, this is going to shift SRAS outward for lowering taxes, rightward for lowering taxes. It's going to shift SRAS inward or leftward for raising taxes. And the same is true of subsidies. If the government increases subsidies for producers, that's going to shift SRAS outward. If they're going to cut those subsidies, that's going to shift SRAS inward. And the same is true of government deregulation. The productivity changes, you may remember, this is new technologies we talked about in Think Trice for a shift in the supply curve. The same is true here. New technologies can also shift SRAS. If there's new productivity changes, that can shift SRAS outward or rightward, and any bugs, any viruses, any glitches, any problems, that's going to shift SRAS inward or leftward in terms of those productivity changes. So this is what's going to shift SRAS in terms of leftward or inward, rightward or outward, based on the positive or negative scenarios that we see there. And we see this shift, again, is leftward or inward to AS2. If we're talking about a shift inward, maybe it's a tax that's being imposed or a subsidy that's being cut. AS1 is where this short-run aggregate supply curve would shift if they were increasing subsidies or cutting taxes, they were increasing productivity, or the consumers expected lower prices. This is going to shift SRAS outward or rightward in terms of what we see there. And you can look at these in the notes. I'm not going to go through each one of these in detail, but just to follow where SRAS is going based on an increase or a decrease. So notice here in commodity prices, if commodity prices are falling, short-run aggregate supply, or SRAS, is going to increase. That's going to shift the SRAS curve outward or rightward, as we've talked about there. If you see a decrease, that's going to move it inward or leftward. And the same is true of nominal wages and productivity based on what we were just talking about there. And that leads us to our first key graph. This idea of the SRAS, ADAS model with a negative supply shock. So in this case, we have a situation in which supply is actually decreasing. It is moving to SRAS1, as we can see here. Equilibrium moving along the demand curve, along the aggregate demand curve to E1. We have a shrinking real GDP. We go from YE to Y1. So this is that recessionary gap I was talking about. And notice here, the problem is that the price level is rising in this particular case. So price level is higher even though real GDP is falling. And that's a negative supply shock. That's a problem that people will have because government just can't throw money at this problem to solve supply. If you don't have it, you don't have it. And so it's really hard to overcome that in terms of being able to address it. Unless you can solve the supply shortage, you're going to have a problem that's going to be harder to get out. And this is with a negative supply shock we saw in the late 1970s with the Middle East conflicts and the anti-American sentiment in terms of not wanting to trade oil. and all of the cars running on oil. We talked about this in class with the long gas lines. This is the problem that leads to stagflation. This idea of stagnant wages. Wages haven't changed here, but clearly there's a recession and price levels are rising. They're clearly increasing. So this is the stagflation that we talk about here, and leads to the cartoon in terms of, well, I've got a hungry puppy and it's called stagflation. I love puppies, but the only thing to keep in mind is the more that he eats, the smaller he gets. So should I feed him less? No, he's going to get even smaller if you do that. Goodness, well, now what am I going to do? He's eating the furniture. So along with your house, your job, your nest egg, and then poof, he's gone. Poor little guy. What happened there? Cheer up. That's when Runaway Cat returns, and there she is. There's recession. Thank you so much for coming back. Love that cartoon because it really shows you there's not an easy way to solve stagflation. When you have rising prices and stagnant wages and you're in a recessionary period, there's no easy way to get out of it. Japan in the 1990s had this problem, a liquidity trap. They had lowered interest rates so low they couldn't go any lower, and here comes a recession. Now what are we going to do? You got to spend, and hope in some way, shape, or form it leads to more supply in those areas because of the supply shock that you're in, the supply shock that you have there. You can't just produce your way out of it. You don't have the resources to do that. So debt is really the name of the game. You go into debt, you try and spend, which is going to shift more aggregate demand than supply, but hopefully, ultimately, it helps to loosen the supply chain and help with your negative supply shock. And that's really the purpose in terms of what you can do. Jimmy Carter couldn't do a whole lot in that scenario, and that was really the reason why. You can't solve a supply shock as easily as you can a recession when it comes to aggregate demand. You can throw money at aggregate demand. You can't do that with a negative supply shock. It's much harder to solve that problem. Okay, a great activity. I'm not going to go through it here in detail. It's in the slides, but activity 3-3 is a great activity for you to do here that really introduces you to SRAS and some shifts in the curve in terms of what's happening here with aggregate supply, with the short run aggregate supply. What are the changes being made, and what impact is it going to have on the curve? So you can check that out in that activity there. We're going to go on to aggregate demand and look at aggregate demand in this model. So the important thing to notice here about aggregate demand is that it is downward sloping, much like the demand curve was that we talked about in the basics of supply and demand. But this is aggregate. So this is showing the overall demand of all price levels and all quantity of goods that businesses, government, exports in terms of net exports, exports minus imports, and households, consumers are demanding at various price levels. So this is downward sloping, very much like the demand curve. And we see this is all about all the different points at which people are willing and able to buy different purchases. So think of aggregate as adding everything all together. When we combine all those prices and quantities, that is what we see here in terms of aggregate demand. It is downward sloping. It is encompassing all levels of prices at various quantities of real GDP in terms of what's being established here. And the demand is for everything by everyone inside the United States. The idea there, and again, as well as net exports, the idea of exports minus imports in terms of what we've got there. Notice there's an inverse relationship here between price level and real GDP. It is downward sloping. Let me just show you the graph for a second. It is downward sloping, and notice that as the price level falls, the real GDP grows because quantity demanded increases as the price level falls. We know this from studying the demand and supply curves. Demand curve is downward sloping. It's an inverse relationship to price because as the price level falls, real GDP is going to grow. And that's what we see here in this model. It's an inverse relationship. So when you have inflation, your real GDP demanded is going to fall because price levels are rising. You don't want too much of that inflation. A little bit's okay, but when it gets out of control, it's going to impact your real GDP. That's going to lead you to recession. If you have deflation, prices are falling, real GDP demanded is going to increase. But again, you don't want to do too much of that, getting into that habit. You don't want deflationary pressures. Then those sticky wages aren't going to be sticky very long. And that's another prime concern that we have here. Notice the aggregate demand curve here is made up of GDP. This is that formula that we talked about in the last chapter, the idea of consumer spending, investment spending, that's business spending, government spending, and net exports, the idea of exports minus imports. So this is all that consumers, businesses, the government, foreign countries, and foreign entities are buying of our goods and services within our country, within our GDP. And there's no inflation in this number. So the idea here is, as we look at real GDP, we're looking at inflation that is not a part of this real GDP. So when we see price levels falling or rising, we're looking at real GDP growth or a lack of that GDP growth, and that is of concern in terms of what we see there. Now, there are shifts in aggregate demand, and mainly it comes down to spending, but otherwise, changes move along the curve. Changes in a price level are going to move along the curve. They're not going to move the entire curve itself. The same rules apply as what we talked about with supply and demand. Price is never a shifter of a demand or supply curve, and price is never going to be a shifter of aggregate demand or aggregate supply either. So that's important to keep that in mind. Price is not a shifter. Again, the same rules apply. Now, notice in 1933, with the New Deal, with FDR and the New Deal, the government did a lot of Keynesian economic theory, which we'll talk about at the end of this chapter, but really trying to address throwing money at the problems to try and create government programs. Remember the ABC soup of the New Deal programs. All the different programs that were trying to create jobs, get people back to work, get people working again. And this is the idea of real GDP growth. It really contributes to the growth. So this is as a result of government spending. Government is spending here, trying to throw money at the problem, and it's working. It is working. The Keynesian model really is working and putting people back to work. Now, that's going to take time. It doesn't just happen in a day, obviously not even in a year. But the idea is over time that real GDP starts to take off and starts running again, and probably bypasses where it was in 1929, somewhere along in here, and keeps going and continues that growth that we continued to see. But we're also going to see some aggregate demand curve shifting coming up that is going to have an impact on that, and spending definitely does do that. So why is an aggregate demand curve downward sloping? There's a couple of reasons. The first one is the wealth effect. The idea of higher price levels is going to reduce purchasing power. If you have higher price levels, and then people can't buy as much as they could with lower price levels. So when price levels are higher, the quantity is going to be smaller, which means real GDP is going to be smaller. If you have lower price levels, you're increasing purchasing power because I can buy more goods and services with those lower price levels. So I can buy more as a result of that, and that's going to improve real GDP. So the idea there is that price level goes up, GDP demanded is going to go down. Price level goes down, the GDP demanded is going to go up and going to increase as a result of what we see there. The interest rate is another factor here, and this is why the Fed gets so involved with this. The Fed chair, Jay Powell, was talking to Congress today about this very thing, this concern about inflation and interest rates. And what you have to keep in mind is that the price level, when the price levels go up, the Fed may be concerned about inflation, and so they're going to charge higher interest rates because they need to slow people down in terms of their purchasing power. There's too much steam ahead of all the money that's being spent out there, and the concern is you don't want to get ahead too far ahead of that, or you've got inflationary pressures that are going to lead to slowing real GDP. So they're going to raise those rates. That's going to discourage spending by consumers and investment by businesses. And that's going to temper things. It's going to slow things down. Because again, as those prices, as the interest rates go up because of seeing the price levels go up, that's going to temper how much people can buy, that purchasing power at those higher rates. And it's going to slow people down. They're going to think twice about spending some of those investments that they see there. So that's also why AD is downward sloping. And there's one last reason, and that is the foreign trade effect. This idea that foreign buyers are coming in and buying our exports. And the idea here is that if we have price levels that are too high, then our dollar, our currency, is going to be too strong. And we talk about this more in Unit 6, but we introduced it here because it really does impact aggregate demand. If you have a very strong currency and foreign buyers want to come in and buy your goods and your currency is really expensive, it's going to be hard for them to buy a lot more goods at those higher prices. They're going to be more reluctant to do so, which is going to kind of put a damper on how much they're buying from you. With a currency that is lower in value, with those price levels lower, then foreign buyers are going to come in and buy a lot more goods. They're going to feel like they're getting more bang for their buck. And so they're going to buy more as a result of that. That's going to improve real GDP. But with a higher price level, they're not going to be able to do that. And that is why having a currency that has lower price levels is going to be more beneficial in terms of growing your economy, in terms of growing real GDP there. And that's why AD is also downward sloping, because as those price levels go up, we're going to have less net exports. We're going to have fewer exports and more imports, and that isn't going to help our real GDP either, because again, it's an equation, right? And real GDP is a combination of consumer investment and government spending and exports minus imports. If your exports aren't greater than your imports, then you're going to have a trade deficit, and that's going to impact other parts of GDP in terms of that consumer, government, and investment or business spending that we see there. So what's going to shift the AD? What's going to shift this aggregate demand curve? Well, mainly spending. And so if you think of it that way, look for a sign of shifting AD. This is all about spending. Notice the sign here is all about spending by consumers, spending by businesses, investment, spending by the government, and spending by foreign governments and foreign businesses. So all of this comes back to spending. So if aggregate demand is shifting, it's because of spending that's happening as a result of what we're seeing here. Now let's talk about consumers. If there's a change in consumer spending, and that's going to impact AD. If it's in a positive way, in terms of more consumers are spending money, they feel more confident in the economy, that's going to improve AD. That'll shift AD outward or rightward. If investment spending by businesses is actually falling and they're not spending as much in those spaces, that's going to shift AD inward or leftward. If the government is spending money, and again, throwing money at it, this isn't government actions for producers, this is actual government spending. They're going out and spending money, contributing like they have been during COVID for coronavirus stimulus packages, going to businesses, going to consumers, going to all of the above. And that is going to shift AD outward. It's going to help aggregate demand in terms of increasing the aggregate demand that we see here. So that's a shift in the curve. And net exports would do the same. More net exports in terms of exporting more and importing less is going to increase that foreign spending. That's going to shift AD outward or rightward in terms of what we see here. So leftward or inward, AD is falling or decreasing. This is going to lead to potentially recessionary tendencies at AD2 versus AD1, where we have prosperity and expansion in terms of our economy, in terms of our GDP growth that we would see there. And again, we all come back to GDP, that idea of consumer, investment, government, and net export spending. So consumers are spending money, businesses are spending money, government's spending money, and foreign governments and foreign entities are spending money as well. This looks at the back and forth. So a rightward shift would be outward, an increase in demand would be rightward or outward. A decrease in aggregate demand would be a leftward or an inward shift in terms of what we see there. And that leads to our next key graph, a positive demand shock. This aggregate demand is moving outward as a result of spending, so some type of spending is going on here, and that's leading AD to shift outward, leading to higher price levels, but a greater real GDP. So we've got a higher price level here, even though the real GDP is growing. This is what we call the inflationary gap. The idea that there is a concern about price levels here. But real GDP is growing, so maybe we want to keep an eye on it. But we want to encourage the growth because AD is moving outward. Real GDP is growing, but just keep an eye on that inflation so that it doesn't get out of check too fast, too quickly, and then we've got runaway inflation. We definitely don't want to have that. Notice here that we have this is a short run entity, and we'll talk more about this later in the chapter. But the idea is we always start at where short run and long run meet at AD. So short run, long run aggregate supply meet aggregate demand at equilibrium. That is our long run. We begin and end there. In this case, AD shifts outward to E1. Something else is going to happen to bring us back, and we'll talk more about that later. But that's the idea of this is a short run model based on what we see right now, because AD is not ending back up at LRAS. E1 is the new short-run equilibrium in terms of what we see here. Now, something's going to happen. Either AD shifts back or SRAS shifts back, leading us back to long run. in that mentality, but the idea there is currently we would be in short run. Let's look at one more graph here before we move on, and that is a negative demand shock. So this is the opposite of what we saw in the last graph. We had a positive demand shock. This is a negative demand shock. Notice price levels are falling here because AD has shifted inward or leftward, leading to a real GDP that is actually smaller than it was before. This is also in the short run because notice we're not at where SRAS, LRAS, and AD meet at equilibrium. So this is what we call a recessionary gap. The idea here is that price levels have fallen, real GDP has fallen, and we need to be concerned because businesses are probably closing, people are losing jobs, and this is concern that if we stay here too long, that we could be in recession and have even more businesses closing and people out of work. Now, the positive to this type of a graph is AD is easy to fix. It is not like a negative supply shock. A negative demand shock is a lot easier to fix because all you have to do is throw money at it. Government spends money and it moves AD back to long run. You improve real GDP through that spending. Why do you think when COVID initially shut down all businesses and schools and such back in March and April of 2020, why the government spent to the tune of $7 trillion, all kinds of aid packages? They were trying to really pump up the economy, to really get things to grow, and to keep things moving outward and find new ways to keep everybody afloat. The Fed did the same thing, buying bad debt by corporate entities and trying to support them in those efforts. Why were they doing that? To keep confidence up, to keep the markets up, to keep confidence up, to keep AD up. So people were still going out and spending money, and it has helped. We're certainly not anywhere close to back to where we were before the pandemic started. But this is an example of where spending really can help to improve a recessionary gap just by shifting AD back to long run in that respect. So some factors that will shift aggregate demand, as we talked about in terms of looking for a sign, that change in expectations, it can impact the aggregate demand curve here. Notice if consumers are more optimistic, they're going to go out and spend money. That's shifting AD to the right. If consumers are less optimistic, that's going to shift AD inward. The same is true of wealth. If people have more assets, that's going to shift AD outward versus fewer assets in a recession. That's going to shift AD inward. And we see the same here in terms of existing physical capital. If businesses are going out and spending on inventory, that's going to improve AD. If they're cutting back on those types of things, again, that's investment spending. That's going to shift AD leftward or inward. And then the fiscal and monetary policy is the government spending that we talked about before. So again, going back and looking at what shifts aggregate demand, look for a sign, look for spending in some way, shape, or form, whether it's consumers, businesses, government, or foreign governments. The spending is what is going to impact aggregate demand, and that really is going to be the most helpful in terms of what is shifting aggregate demand. How does an economy get out of a recession? Well, if it's an aggregate demand recession, if it's a demand shock that is the problem, spending is a great way to make that happen. And the government is looking at the Biden administration's stimulus plan now for recovery. And again, what are they looking at? They're looking at $1.9 trillion to help shift aggregate demand further outward or rightward. That is the approach that they're taking here. And there's a great activity to go along with this, activity 3-1. The notes are in the slides. This is in the modules section of my MCPS classroom. Hope you find it helpful. We did a couple of these in class, but again, you can go into more detail there in looking at why is the AD downward sloping in that particular exercise. Okay, now we're going to take a look at the multiplier effect. This idea of why is it that the people want the Olympics to come to their town? Why is it that the Super Bowl is a coveted event in terms of why people want the Super Bowl to show up in your city, and why some of these popular events that people have, why different cities are fighting for them all the time. It's called the multiplier effect, and it's the idea that any change in spending spending is going to be offset by kind of a ripple effect, a chain reaction that is magnified throughout the economy. And so this magnification is what we see here when people go and spend money. When people go to the Super Bowl, they don't just go to the Super Bowl. I mean, you think about this. They're going to the Super Bowl, they have to buy tickets. They have to stay somewhere, so they need a hotel room. They're going to have to eat, so they're going to have to eat at restaurants. They're going to have to fly there, or they're going to have to somehow get there. So they're going to have to buy transportation, some type of airfare or train or bus or whatever it is. They're going to they're going to spend money while they're there on different souvenirs, and maybe it's shirts from the game or whatever, something special to commemorate the Super Bowl. So all of these involve spending money in various capacities in terms of how people are spending money, and they're spending a lot of it. It's not just about the ticket to the game. It's about all of these things that they're buying that contribute to the economy of the city that the Super Bowl is in. And that really is the multiplier effect that we see here. So, and you think about it this way. If Bobby is spending $100 on Jason's product, Jason now has money that he's going to go out and buy something with, and he's going to buy something from Nancy. Nancy now has more income. She's going to go out and spend money too. She's going to buy something from Tiffany, and you can see that the process continues. Now, we started with $100, but what we ended with in this scenario is $300 in consumer spending. That's the multiplier effect at work. The idea here that with $100, this can continue and continue and continue to the point that it creates an economy based on that $100. Now imagine the government stepping in and spending to the tune of $1.9 trillion, the effect that this can have in terms of the multiplier on different programs and the Paycheck Protection Program, the for businesses and for consumers, and the checks that are being mailed out to people. All of this important because it's helping to shift AD. It's helping to get the economy going again, and to keep the economy afloat for people that are really just surviving and focused on concerns about falling through the cracks. So that really is of major concern here. So some of the effects, again, as I said, if the government spends $5 million, the idea is that AD is going to increase by even more than that because of the multiplier, because of that ripple effect that we see here. It's an expansion of AD. So it's not just $5 million that's at work. It's much more than that. And it's going to depend on how much people are consuming, spending, versus how much they're saving. So if they're saving a lot, they're putting it all away. This happened after 9/11. Checks were mailed out, and people paid off their credit cards and paid off their debt. They didn't go out and spend it, which led to a recession. And the concern there is the reason the government is giving you money is to go out and spend it, and because we are a consumer-driven economy, 70 to 75% of our economy driven by consumer spending, it's really important that people go out and spend that money. That really contributes to getting the economy humming again, really getting it growing. So how do we know how much that this government spending is really having an impact? Well, there are two formulas we need to know here that we need to address. The first one is the marginal propensity to consume. This is the idea that how much you're going to consume is going to be out there in disposable income. You're going to spend the money, and the MPC is going to help us determine, based on this multiplier, how much is actually going to the economy. So if you receive $100 and you spent $50, that obviously is a change in consumption change versus disposable income in terms of what you had versus what you spent. This would be one half in terms of that scenario versus the receiving $100 and spending $100. That's an MPC of 1 because the idea here is the change in consumption. You're spending $50 versus the disposable income you had, which is $100. And so that would be an MPC of 0.5 versus the $100 over $100, which is an MPC of 1. And we're going to use that here in just a second. So if we look then at the marginal propensity to save, which is the idea that instead of spending, we're saving. And by the way, the idea here is you're only doing one of two options. If you're not saving, then you're consuming, you're spending the money. And if you're not consuming or spending the money, then you're saving. There's nothing else you're doing with it in economic terms. So ceteris paribus, if you're not saving, you're spending. And if you're not spending, then you're saving. And so we can simplify this multiplier effect by looking at it in this way. So marginal propensity to save is the same formula, essentially. In this case, it's a change in savings over a change in disposable income in terms of what you see here. So in this regard, you would look at it in the same way. You receive $100, you're going to save $50, so 50 over 100 again simplifies to 1/2 or 0.5. Now, it's interesting, in the second example here, we have an MPC of 0.7. We can get the MPS by using this formula, which is essentially that MPS plus MPC equals 1. Okay, they always add up to 1 because, again, you only have two options. You're either going to save or you're going to consume, and there are no other options that are available here. So you're either going to save or spend, and those are the options that it comes down to. So how do we use this then to calculate the spending multiplier? Well, the spending multiplier is one of two formulas. It's either 1 over MPS or 1 over 1 minus MPC. Either one will get you there in terms of the spending multiplier, okay? So 1 over MPS or 1 over 1 minus MPC is essentially going to give us the spending multiplier. And what that is, if you had an MPC of 0.5, how much is the multiplier? Well, we could put that in. The idea of 1 over 1 minus 0.5 is 0.5, and 1 over 0.5 in looking there would give us our answer. So if the multiplier is 4, how much will an increase of $5 in government spending increase the GDP? And you can see this here in terms of you have $5. If the multiplier is 4, then you're going to end up with $20 essentially in this multiplier effect. Increasing GDP. So that $5 investment, and that doesn't sound like much, but if you're talking about $5 billion, and then you have $20 billion as a result of a multiplier of 4, you can see how this quickly grows. It quickly grows into something much larger than what we see here. And obviously, if you're cutting spending in those terms, that can actually cut into your spending multiplier. That's going to be the reverse of that ripple effect. So it's not just taking that money away, but taking the multiplier away. So you're actually losing, not just losing $3. But with a multiplier of 4, you're losing $12 in terms of what could have been spent out there. So think of it that way in terms of those changes. So that initial change in spending, you got $5 times the multiplier 4, you got $20 in change in GDP. If you're cutting $3, again, that is a negative number. So the multiplier is 4, you're taking away a negative $3, which is negative $12 in GDP. So it's much more significant when you're cutting than as well as when you're spending. You got to be careful on those. So here's some examples to work out, and you can again pause the video to take a look at some of the multiplier effects here that I think you'll find helpful in terms of addressing the Super Bowl example and the multiplier. If we look at the multiplier effect, again, and here's some more examples you might want to pause the video to take a look at here. If you had an MPC or of these 0.9, 0.8, 0.5, whatever the case may be, you can plug it in terms of getting what the spending multiplier would be. So in these aspects, again, you're just 1 over 1 minus whatever MPC is. In number 1, it's 0.9, so 1 over 1 minus 0.9 is 0.1. 1 over 0.1 is 10, so the multiplier is 10. So whatever they're spending, if it's $1 billion, that's $10 billion that is being multiplied there. So what's the long and the short of this? Well, as your marginal propensity to consume falls, the multiplier effect is also going to fall. As the marginal propensity to consume grows, as more people go out and spend more money, the multiplier effect is going to be greater. And that contributes to real GDP. That contributes to your growth. Now, the question I always get is, what about tax cuts? If you're cutting taxes, this is always going to have less of an effect, okay? Always. It's never going to have the same effect as the spending multiplier. The tax multiplier is always going to be 1 less than the spending multiplier. And that's because when you spend money, the ripple effect is always greater. anytime you're dialing back tax cuts or adding taxes or cutting those taxes back, you're never getting the same effect as when you're just going out and throwing money at it and spending money in the economy. That ripple effect is much greater. So what you're going to see here with the tax multiplier is this idea of cutting taxes is still going to help, but not nearly as much as what you're going to see with the spending multiplier. So in calculating the tax multiplier, in this case, MPC times 1 over MPS, or simplified, it's MPC over MPS is the tax multiplier, and it's always going to be smaller than the spending multiplier. And if you just keep that in mind, I think that will help you in terms of taking a closer look at spending versus tax multiplier. In a lot of the AP exam questions, a lot of times they'll give you the MPC, or they'll give you the MPS, or they'll give you what the multiplier is in those cases, because they want to see that you can actually analyze the situation in terms of, hey, spending is always going to be greater, and you'll definitely find that beneficial when you get questions on the multipliers. There is an activity here. It's 3-2, which addresses this. And again, we're doing these a couple of these in class, but I think you'll find them helpful in terms of taking a closer look. All of these are in the modules of my MCPS classroom. There's another activity here also in those shifts in SRAS and AD that we talked about last time. This is activity 3-5 that I think you'll also find helpful here, and 3-6 that address changes in SRAS and AD. Okay, now we're going to look at the long run. I kind of alluded to it in earlier key graphs that we were talking about, but now we're going to look at this long run aggregate supply curve. So what is it? Well, it's a relationship between price levels, all the different price levels, and all of the different quantity of outputs that exist. If all prices, including nominal wages, and you remember their nominal wages includes inflation, those inflationary tendencies, if all of these items were fully flexible. Okay, what do I mean by that? I mean that there's no sticky wages anymore. The idea of the supply curve here is going to be a vertical line because it's going to include all the price levels at all the different outputs of those prices. So if a firm is making 100 units that are sold for $1 each, and the cost is $80 of labor, what's the profit? Well, that's simple. It's 100 minus 80. The idea is $20. So in the short run, if prices double, you can sell them for more, and your total revenue is going to be $200. And your labor is 80, giving you a profit of 120. So you actually benefited in the short run because wages were sticky. But in the long run, wages aren't sticky, and you're going to have to pay more for your labor, for your workers. And that means that you're going to have to rise to the price levels that are now indicative of wages in the long run. And at this point, that's a $100 increase, a doubling of the labor, so $160 of labor instead of $80, which leads you to a profit of $40. Well, if you look back to your original units, you sold 100 units and you made $20. Here, you're selling 100 units, but the price value is $200, and now you're making $40. So you really didn't gain anything because you're paying more out in terms of labor and wages. So there really is no incentive to produce more in this model because your profit is essentially the same in terms of what you're producing here. So the long run helps us see where is production actually beneficial to produce more and make more money. And in this model, we can see there's no benefit to producing more and making more products here to sell because we're essentially making the same amount of money we were making back in the short run. And so there's no incentive to leave that space. And this is the vertical line that I talked about, the LRAS, or the long run aggregate supply curve that we see here. Notice that varying price levels doesn't matter. It's going to go up or down, but the idea is that output is essentially the same. Now, what we see over time, because this is long run, what we see over time is that our long run aggregate supply curve functions very much like a PPF. If you think of it like that, in terms of this LRAS curve is really the the bottom end of the PPF down here. It's really just the smaller portion that we see of the PPF. And as that PPF pushes out new technologies, new resources, new ways of doing things, we can see our economy is growing. Our real GDP is growing as a result of those technological innovations. So that's the way I want you to think about it when it comes to LRAS. It is very much like a PPF that is shifting out the curve. Maybe 1997 was point D that we were finally able to reach because the LRAS curve shifted rightward as a result of new technologies and new innovation. And that really is the economic growth that we strive for. If an economy is moving in the other direction, and we saw some of that taking place in the Great Depression model, we don't want that. We want our economy to continue to grow. And we're either growing or we're shrinking. So we want it to grow and we want it to move rightward because that means real GDP is growing and there is growth in our economy. Now, we can see the actual versus potential output in terms of this aggregate output over time. You can see this is measured based on some of the years that you see here. And for the most part, we see the output, the real GDP, that continues to grow over time, over these periods. Now, actual versus potential, the idea here is if all prices were fully flexible, we would see what the potential output is. And from time to time, this actual will be lower. Those are usually during recessionary periods, or at least maybe not recessionary periods, but recessionary gaps. We're not in a recession until we have 2 quarters of negative growth. You can have a recessionary gap and not have a recession, because if you're able to shift AD and get out of that recessionary gap and get back to long run, you may avoid the recession altogether. But that's really hard to do because, as economists will tell you, usually you don't know you're in a recession until you're already there, and likewise, you don't know you're out of it until you're already out of it. And so, because the data is lagging, even in today's technology, the data is still lagging. It's really hard to gauge that. So that's really where we see the idea of long-run growth. And this is our next key graph. Looking at long-run growth here, the idea is we want to push out the PPF. By pushing out the PPF, we're growing real GDP. We're using innovation, technology, and new ways of doing things in order to grow our economy. And that's indicative of the long-run growth we see here. Now, the difference between short run and long run, as I talked about earlier, I want to mention again. Short run, wages are sticky. Resource prices, inputs are sticky. You can't renegotiate those. Think of them like we talked about in micro, when a business owner signs a lease on a building and times are tough, and so they can't get out of the lease. They're stuck. That's essentially the sticky wages, the sticky resource prices we're talking about here. But in the long run, I can get out of that lease. I can renegotiate that lease. I can negotiate wages that are lower for my workers. Maybe the workers I have will leave and the ones I bring in at lower prices because it's hard times and they're happy just to have a job. So over the long run, I can flex those prices, those resource prices. I can adjust and really accommodate more changes in those prices where I can't do that in the short run. And that really is more difficult there. So leftward shift of SRAS, notice, is moving in terms of a rise in nominal wages. That is shifting SRAS leftward or inward. And a rightward shift is when we have a drop in those nominal wages. The idea is we're hiring workers, paying them less, SRAS is shifting outward. If we're paying them more, SRAS is shifting inward, and that's what we see here in this model. In the long run, the idea is price levels may go up or down, but GDP is not going to change if we're at full employment. If we've hired everybody that we can, and we'll talk more about that when we get to the chapter on unemployment. But if we've hired everyone that we can, we're at full employment, and that by the way doesn't mean 100%. It's close, but it doesn't mean 100%. Usually, if you're in the 3 to 4% range of unemployment, that's pretty low, and we're striving at full employment there, or our natural rate of unemployment that we'll talk about later. But the idea here is we're producing at full employment. It means that we're producing at maximum GDP. Our real GDP can't be any greater. The price levels may be higher or lower, but real GDP is strong because it's at full employment. We're using every opportunity to make people better off without making people worse off. That's that idea of efficiency, right? And we are efficient when we are at long run aggregate supply, because we can't possibly produce anymore. We don't have anybody else to produce anymore. We can hire, we can develop new technologies and new innovations to shift that curve outward or inward. But the idea there is we want to continue to move outward or rightward. And what's going to shift that curve? What's going to shift LRAS in this model? Well, again, Mr. Rodman coming up with another mnemonic, CC me, right? CC me on that email. This is a permanent change in production possibilities. The idea of the PPF moving outward. What's going to shift that LRAS curve? Well, it's changes in resources. If we have new resources and new ways of using those resources, either in quality or quantity, that's going to shift the LRAS curve outward or rightward. If we have new changes in technology, that's going to shift the PPF, that's going to shift the LRAS curve. And that's why I use PPF and LRAS so intrinsically here, because production possibilities that are changing and shifting outward are shifting LRAS. So they really are one and the same in terms of addressing those shifts in long-run aggregate supply. And we see this here. As you're pushing out the PPF, you're pushing out the LRAS curve. Those are the shifters that can have an impact on LRAS. There is an activity here that I think you'll find helpful, activity 3-8. Again, we'll do a couple of these in class, but this is a great activity if you're not quite understanding long-run aggregate supply that I think you'll find very helpful in that regard. Next, we're going to move to the aggregate supply, aggregate demand model. So we're going to put everything together now. We're going to put aggregate supply and aggregate demand together. We have the upward sloping aggregate supply curve. We have the downward sloping aggregate demand curve, and they are meeting at a price level of PL1 or E, if you will, at equilibrium, and a quantity of Y, or real GDP, that we talk about here. This is where they come together, looking at those fluctuations in short-run aggregate supply and aggregate demand. Notice they're also meeting at long run. Long-run aggregate supply is intersecting AS, SRAS, if you will, and AD. It's meeting them all at equilibrium, at this equilibrium at price level. That's really important here, because the driver is full employment. And if short-run aggregate supply meets aggregate demand at LRAS, we have full employment. We have everybody working that can. Our real GDP is essentially maximized in that economy in terms of what we can do at all various at these various price levels as part of our GDP. Okay, full employment, it's long-run equilibrium. That's our potential output. Inflationary gap, that's the positive output gap we were talking about before. The idea that you're concerned that that AD is moving outward and price levels are rising, but your real GDP is growing. That's an inflationary gap or a positive output gap. Recessionary gap, aggregate demand moves inward or leftward, shrinking real GDP. You're at less than full employment. That's a recessionary gap. That's the idea of a negative output gap, if you will. And that really is the driver of recessionary gap. How do we get out of it? Well, if it is an aggregate demand issue, you can throw money at it, spend, and that can help get you out of recession. If it's a supply issue, it's a lot harder to solve, as we talked about before. So there's only really three places you can be at any time in terms of where you are in the macroeconomy. You are either at full employment, which means you're producing along the PPF. You're at negative output, which is that idea of recessionary gap, or you're at positive output, that inflationary gap. Notice that blue line is unsustainable. We can't get there. We're never going to get to 0% unemployment. It's just unrealistic. If we can keep it below 5% unemployment, that is essentially full employment. That is our natural rate of unemployment in terms of what we see there. And so notice real GDP fluctuates along this business cycle. And this business cycle is intrinsically tied to the PPF. So just like long-run aggregate supply is this little part of the PPF here, we can see that the business cycle is also tied to the PPF. If you're within the curve, that's recessionary gap or negative output gap. If you're beyond the curve, that's prosperity, peak, really, in terms of that positive output gap. Concerned about an inflationary gap in terms of what you see there. And then along the curve, you're at yellow. That is full employment. That is the idea. You are producing at capacity, at everything you can possibly do there. That essentially is full employment and where we want to be in these models. So if the government increases spending, what's going to happen? Well, notice AD is shifting to the right. Price levels rise. We have a quantity, a real GDP that is greater, and this is leading us to an inflationary gap, right? We have a positive output gap here. And that means unemployment is less than our natural rate of unemployment, below that 5% we were talking about. So 3.5%, 4%, wherever it is, that's a good place to be. But we're concerned about price levels. We're concerned about inflation. So that's a positive output gap because we've moved along the short run aggregate supply curve to a higher price level at this actual GDP, which is clearly above where we were at potential GDP down here at full employment. So if consumer spending were to fall, what would happen in this case? Well, notice AD is going to shift inward. And price level is going to fall, but we're also looking at a recessionary gap or a negative output gap in terms of what we see here. Notice that the output is lower. We're not producing at full employment. We're not producing at our capacity of real GDP. That is a problem in terms of what we see here. And so this is the recessionary or the negative output gap that we see in this model. People are laid off. People aren't working. So this is not where we want to be. We have that a recessionary gap usually means that there's unemployment, that people aren't working, and that we're not living up to our full potential in terms of what we could be producing at real GDP, at full employment. So that is a problem. And what we strive for is to get back to long-run equilibrium. What these models are showing, negative output gap and positive output gap, are that we are in short run. We are in short run macroeconomic equilibrium because the idea there is we want AS and AD to be equal at LRAS. That's long run. But in these models, in terms of what we saw here with the positive output gap, notice AS and AD meet over here, but LRAS is over here. That is not a long run. So this is a short run positive output gap model because SRAS, LRAS, and AD don't meet all in one place. So that tells us this is a short-run model of a positive output gap or an inflationary gap. The same is true here. We are not at LRAS meeting SRAS and AD all connecting in one place. So we have a recessionary gap. We have unemployment. We have a potential recession. We're not at full employment, and we're not at real GDP at that full employment. So that's a negative output gap in terms of what we see there. So these do matter in terms of where do we find AS and AD. That's going to tell us where we are in the short run. If they meet at LRAS, then we know we're in the long run in that respect. And that is our short-run macroeconomic equilibrium model. Now, if LRAS is right here along this yield at equilibrium, then we would be in long run. But in this case, if it's to the left or to the right of this long-run aggregate supply curve, that straight line, then we are in short run. And in this case, they're showing that is a short-run macroeconomic equilibrium model in terms of what we see there. Notice the negative demand shock, again, short run. A positive demand shock, also short run, because they're not at full employment. They're at inflationary gap. You got higher price levels to worry about, but you have an unemployment that's lower than the natural rate, the NRU, the natural rate of unemployment. And in here you have an unemployment issue that you would have to address. Shifts in SRAS, same problem. Again, you're in short run. The idea here is you're not at full employment. A negative supply shock. So in this case, you've got stagflation. You got that negative supply shock. Here, positively, you have a rarity, I might add. You have a positive supply shock when you actually prices are falling and real GDP is growing. This is a great place to be, and not a place that we are very often. But this is a great thing for the economy. And we could argue, the tech boom of the 1990s was probably a model here that we could see in positive supply shock because you had a plethora of tech companies and startups and other companies that were just dying to hire people to help out with their models, and that really is well below the natural rate of unemployment in terms of what we see there. So very helpful in that regard. So some hints to keep in mind in terms of shifting AD or shifting SRAS curve. Don't forget about the IRAP for shifting SRAS. The idea of looking for a sign of shifting AD, all about spending there, and that's really going to help you in terms of those shifts. Terms of those shifters. Try not to use up or down. Try to use increase or decreasing, rightward or leftward. Those are going to be more helpful to you and when you address them in any type of FRQ or in multiple choice questions as you address those key graphs. So if we have a negative supply shock of oil, what happens to price level and output? Well, in this model, we have stagflation. You can see here, if we start out here at SRAS meets AD meets LRAS, that's at long run equilibrium. We can see this is a short run model because SRAS has shifted leftward, leading to a higher price level and a smaller real GDP. This is stagflation. Stagnant wages, higher inflation, price levels are rising, and potential recession, recessionary gap in terms of what we see there. Likewise, if there's an increase in consumer spending, we can see that again, it's a short run model. AD is shifting rightward, leading to higher price levels. Again, we have inflation, but in this case, we have greater real GDP. So we're worried more about an inflationary gap here than stagflation in that recessionary gap we saw before. And there's a number of practice questions in the take-home quiz and on MindTap that I think will help you with this ASAD model that is so important. Okay, now we're going to shift to this idea of long-run macroeconomic equilibrium. And we've kind of addressed this in a number of different ways already, so I think it'll make more sense as we go there from long run to short run and back to long run again. So the idea of long run is when you have SRAS and AD meeting LRAS at their intersecting points, okay? This is the idea of full employment. When we see long-run macroeconomic equilibrium, what are we looking for? We're looking for SRAS and AD to meet at that LRAS curve, okay? So in this model, we have SRAS and AD meeting at LRAS, at full employment. This means this is our potential output in terms of what we're producing. We've maximized our full employment, so we're producing a real GDP that is at full employment. We can't hire any more workers. We can't possibly produce any more. We're producing at our capacity in our economy, all price levels, all GDP products being produced. And this is long run. Now, what we see in terms of differences is that short run is going to shift SRAS or AD because, again, those wages, we keep coming back to wages and resource prices, those shifting SRAS and AD models, whether it's spending, whether it's IRAP, whatever the case may be, that is going to shift these curves is going to lead us into short run macroeconomic equilibrium. And then to get back there, we're going to have another shift of either that same curve back to its original point or a shifting of the alternative curve back to long run. And let's take a look at a couple models in which this happens. So if consumer spending increases, what's going to happen in the short run and in the long run? Well, in this case, what we see is we're at long run equilibrium. And the idea here is we are starting out at long run equilibrium right here at E, at a quantity of real GDP, or Y, the yield of that GDP. AD is moving outward or rightward. This is leading to a higher price level. As a result of that higher price level, we have sticky wages. Wages are going to increase eventually, but maybe not in the short term. But ultimately, over time, when we get back to long run, those wages are going to have to go up. And that means our resource costs are going to go up, which is going to shift SRAS back to long run. So notice AD shifted out here, but SRAS, because of those sticky wages, is going to have to shift inward or leftward. That's going to leave us with an even higher price level. That is not where we want to be. But the idea is we're back to long run. We're back to full employment. But we do have inflation to worry about in that model. So notice here on the business cycle timeline, we started at long run. We ended up back at long run, but we did have an inflationary gap. We did have prosperity in our peak there in terms of the economy was too hot. We had too many dollars chasing too few goods. That was a considerable problem in terms of trying to address that. And so what happened was those sticky wages in the long run no longer became sticky. SRAS shifted to the left, leading to that PL2, the price level, at a much higher price level because of those wages. And so we have inflation to worry about. Now, if consumer spending increases, what's going to happen in the short run and in the long run? Well, as we said, in the long run, those wages and costs will increase. And that's going to be passed along to the consumer ultimately because businesses are going to have to pay it. So that's a higher price level than what we saw originally. Now, if consumer spending decreases, we have the opposite problem. We have a recession. Consumer confidence falls as a result of something going on. What's going to happen? Well, in this model, what we see here is we start at equilibrium, PLE, in terms of what we see here. And the AD is shifting leftward or inward. That AS curve is moving along the curve to this new equilibrium point, PL1. And you can see here we're in a recessionary gap. We are in a recessionary gap because we're not producing at full employment, our real GDP at full employment. And so we're in that recessionary gap that we see right here. What's going to happen as a result of that model? Well, with the prices falling and real GDP lower, ultimately what this is hopefully going to do as a result of this is leading to lower price levels because, again, sticky wages eventually are going to lead to lower costs. People are out of work. People are willing to take pay cuts. People are getting laid off. These are leading to lower wage prices. And so short-run aggregate supply, due to those lower wage prices in the long run, is going to shift the SRAS curve rightward or outward, leading to a lower price level overall, PL2, in terms of what we see here. So notice we're back at long run, getting out of that recessionary gap. We're back to full employment. But the idea here is that we're at a much lower price level back at that full employment. Now, that is a risky business in terms of hoping that price levels fall as a result of those wages being sticky. In the real economy, it's a little harder to just say, oh, well, short-run aggregate supply is moving rightward or outward because of lower wages. We do that here in the economic models, ceteris paribus, but there's a lot of other factors weighing into that that could keep those SRAS costs from shifting rightward or outward. And we'll talk more about those a little later. So there are a couple of examples here that you can address in terms of what's going to happen here. If there's an increase in consumer spending, we kind of addressed that already. If consumer spending increases, what's going to happen in the long run in terms of moving to short run and then back to long run, and then also in terms of consumer expectations. If consumer expectations are falling, AD is shifting leftward or inward, leading to those the short-run aggregate supply prices, leading to a lower price level in terms of what we saw there. All of these are taking us from long run to short run and back to long run. So notice here, we're at long run at PLE, we're in short run at PL1, and we're back to long run at PL2. We're back to long run aggregate supply. That is our macroeconomic equilibrium in the long run. We're back to full employment there at a lower price level, PL2. And that sets us up for the next short run to long run in terms of what's happening in that next cycle, probably in that next annual or yearly real GDP in terms of what we see that there. There's a number of these in the book that I think kind of take you through this model. I'm going to do one more here, and then there's a number of these that I think you'll find helpful. But notice these are numbered, which I think helps a little easier. If you start out at E1 and this aggregate demand shifts, we're now in short run at E2. In this model. Because aggregate demand moved inward, this is a recessionary gap. What's going to happen? Well, sticky wages don't stay sticky forever. So those prices of inputs fall. That shifts SRAS outward or rightward, leading us back to long run. So long run is at E1 and E3. Short run is at E2. So that middle step between starting at long run full employment and ending at long run full employment is the short run model here. So we go from long run at E1 to short run at E2 and back to long run at E3. And as I said, there's a number of these that kind of take you through this over and over again, but I think you get the idea in terms of the models that are being outlined here, and hopefully that makes a little more sense. Another model to think about in terms of this short run, long run is investment. Investment increases. Well, that's spending. That's shifting AD, right? And in this model, what we see is we have investment is shifting AD because of that investment, and then we have additional resources because of those investments, new technologies and resources that are cheaper as a result. The inputs are lower. That's going to shift aggregate supply outward even further. So notice this model is actually moving long run in addition to aggregate demand and short run aggregate supply. So long run, because the PPF is moving outward, we've got long run in this model that is moving rightward or outward as well. It's increasing. And that's because our real GDP is growing. The tech boom of the 1990s is a great example of this. The expansionary period after the recession of 2009, leading into the pandemic of 2020, but a really long, 10-year period in which long run aggregate supply continued to move outward. This is the idea. And we didn't really have to worry about inflation. So you really had aggregate demand moving outward, short run aggregate supply moving outward, leading to a full employment at long run aggregate supply that was also moving outward because of that PPF. So that is a little different scenario, because I always get that question. What happens when things are coming in and both are moving in the same direction? Well, you can see that it's going to move long run aggregate supply, and instead of moving it back to full employment at higher price levels, sometimes those inputs are cheaper, and those cheaper inputs lead us to even better full employment, even better long-run aggregate supply due to innovation. And again, that's the pushing out of the PPF that we talked about earlier. So an increase in consumption or government spending isn't going to cause that economic growth just because people are saving it or government spending it. It's the investment that's going to cause the growth. And that's because businesses are investing in technologies. They're investing in new resources that are going to help along the way. And that's really going to improve. So anytime you see, should we invest in capital goods or should we invest in consumer goods? You're always going to invest in capital goods more in order to grow long-run aggregate supply, to improve employment. Consumer goods are great, but they are a dead end in that you buy the product and that's it. That's as far as it goes. You invest in capital goods. You're investing in new technologies that can make multipliers of consumer goods, and that's going to push out the PPF much faster by investing more in the capital goods space in terms of what you see here. Okay, so the gap recap, you can pause the video and take a look here in terms of this, the recessionary gap, the inflationary gap, the output gaps we talked about, both positive and negative. And the important thing to mention here is the economy is self-correcting. The idea is, and we'll take a look here before the end of the video, we'll take a look at some of these self-correcting shocks that economists have talked about along the way as being very self-correcting. Keynes said, in the long run, though, we're all dead. In the long run, can we wait for the self-correction to actually kick in? And that was a real concern for this. For the economy. And the Great Depression is a great example of that. In the long run, everybody's dead from the Depression. How does that help anybody to say, oh, the economy self-corrects, it'll take care of itself in the next couple of years? Well, how do you feed your family in that amount of time? So that's really where government spending and government stepping in to create programs to help shift AD really was helping the self-correction along. But ultimately, would it self-correct? Ultimately, it would. But, would you survive it? That's really the question that's at work there. Negative supply shocks, obviously posing some dilemmas in terms of concerns about inflation, as we saw in the negative supply shock and the inflationary gap we saw earlier. And economists talk about this all the time in terms of how much is self-correction. As I mentioned, in the long run, we're all dead. What type of stabilization policies and government spending should the government actually step in to take care of? And this is a continual concern that we'll address before the video's up here in another section. But the idea is sometimes government does need to step in. And we saw saw this last year with the pandemic. Government needed to step in and try and we saw the markets continue to fall day after day. You had 4, 5, 600 points falling in the Dow and the S&P 500 and the Nasdaq, showing that there wasn't a whole lot of confidence in the market and in what was happening at the time. And so the Fed came out and said, "Hey, we're going to buy corporate debt. We're going to lower rates as low as we can." And Congress stepped in with the president and said, "We're going to spend money too. We're going to spend fiscal dollars to get money back. We're going to send checks out, and we're going to encourage people to go out and spend money." All of these are ways that the government can try and stabilize the economy, can help bring us back from recession or keep us from going there. And that really is the critical piece of macroeconomic policy, why it's so important to keep unemployment down, to keep us at full employment where possible, and to blunt the pains of recession as much as we can. There aren't easy options here. And as I mentioned with supply shocks, they're really hard to get out of. When you get into that inflationary gap, there wasn't a whole lot Jimmy Carter could do. When people won't sell you oil to turn into gas, and you can't get it from anywhere, you can spend all you want to, but nobody's buying, nobody's selling you product. It's really hard to get out of that. And it does ultimately fix itself over time. There are alternatives, but that takes some time to get out of as well. So that really is something that we'll look at in more detail as we move forward in a couple of other units in terms of macroeconomic policy, but is important to note here as we look at aggregate supply and aggregate demand. Okay, now we move on to inflation, and this is just a short section talking about two concepts we want to introduce here. And we have a whole nother chapter on inflation later on in another unit, but we want to introduce the concepts of demand pull inflation and cost push inflation. Notice demand pull inflation is the idea that demand from consumers is actually pulling up prices. And this is an increase in AD. If AD is shifting, and think about it, if AD is shifting rightward or outward, the short run aggregate supply curve is going to move along the curve to a much higher price level. This is basically pulling the demand up to higher prices. And so consumers are essentially bidding up those higher prices. Too many dollars chasing too few goods. You probably heard that. Scarcity means people are going to pay more for those items, and they're going like an auction. They're going to increase those prices, and demand is essentially pulling up those inflationary prices. Now, when it comes to resources, we also have what's called cost push inflation. And this is when production costs essentially are pushing higher prices because SRAS is shifting leftward or inward, it's decreasing. This is leading AD along the curve to a much higher price point, a price level that is higher as a result of what we see there. And so that SRAS decrease or shifting leftward or inward is leading to that cost push inflation that we see there. There are a couple of articles in the slides I think you'll find helpful in terms of addressing this idea of inflation, and even one on stagflation in the 1970s that I think you'll find interesting. There's also an activity related to this called Activity 3-7 that is in the modules that looks at this idea of demand pull and cost push inflation that I think you'll find helpful in terms of addressing that. Very short on inflation. Again, we're going to take a look at this topic in greater detail later on, but the idea here is demand pull inflation, that is aggregate demand, that's consumers that are basically pulling up the cost of inflation because they're bidding it up, and then cost push inflation, the idea that production costs are actually pushing up higher prices as a result of what we see there. Next up, we look at fiscal policy as we start to look at how to close out this chapter. The idea of fiscal policy is, if you remember, it's budgets. It's Congress and the president working together to drive policies that are going to help the economy, that are going to help things along. And in good times, they want to cut back on those resources to save money and to keep the economy from getting too hot, from inflation from growing. We want to increase those government spending models of the budget in order to help in recessionary times. So think of it like a car. You can drive 120 miles an hour, but you can't do that forever. Okay, you can also drive 20 miles an hour, but you're not going to get very far, right? So full employment is like driving the speed limit. Think of it that way. You're driving 65, 70 miles an hour, and that's sustainable. You can get to where you're going. The car lasts longer, and as a result, you're at full employment. The economy is very much like that car model. Okay. Now, some cars are built better in order to drive in those faster speeds, and we see this based on comparative advantage, right? An absolute advantage. The idea is that some nations are more equipped with industrial resources or know-how or experience and expertise in those areas, and so they can make those cars and the technology to help with that. And other countries can't. And so that is where we see this car analogy really kind of taking shape. So governments step in order to help along those lines and when an economy needs it, and then takes a step back when they don't. And so what we see here in terms of consumers are most important, right? Because they go out and spend money. If you're not spending, this idea of spending money in autonomous consumption, the idea of regardless of your income, you're going out and spending money. If you're not doing that, you're not contributing to the economy. Okay, a great reason to ask your parents for money, right? Mom, Dad, we're not contributing to the economy if we're not spending. I need this money to help the economy, right? And we do this for necessities, but also for wants and needs, for things that we want to have, things that we want to purchase along the way. And so consumer spending is including all of these things: the autonomous spending, the disposable income, that money you have after you pay your taxes, and as well as any savings, the idea of dissaving. You're going out and spending money that you don't have, and putting things on credit, right? We see a lot of that today. But what happens if people stop spending? What's going to happen if that happens? What if people lose their jobs? We end up in a recessionary gap, and businesses are closing. Well, government, in that case, in a lot of policies, government wants to step in to try and bring the economy back to full employment. How do they do that? How do they stabilize that economy? They use two methods that we'll talk about in the next unit in much more detail, but we're introducing them here to stabilize the economy. How do we get back to full employment? Well, Congress and the president can use fiscal policy, the idea of budgets. They can budget government spending to either to help the economy, to increase spending and cutting taxes to address that. That's essentially what we call that fiscal policy. Or the Fed can use monetary policy. Think of it like a water faucet, like you see here in the cartoon. Monetary policy, you're kind of turning on the faucet and letting it run. Maybe it's just a trickle, maybe it's a lot of water. And the Fed can determine that based on a couple of actions that we'll take a look at, what we call the bird policy, in terms of how they regulate the interest rate on bonds and interest rates for borrowing money to buy a home, mortgages, and as well as other loans like home improvements loans, home equity loans, and other things, as well as the rates that banks charge each other and that the Fed charges banks in order to do this. So this is all monetary policy in terms of what we see there. So let's take a step back and look at fiscal policy for a second. So we have two concepts here of fiscal policy. One is discretionary, and this is the idea that Congress can actually spend money in these areas. There is no set spending. So in a recession, they can increase spending in these areas. In many cases, they don't have the money to spend anyway. They're borrowing it. And so this contributes to the national debt. It forms a deficit for the year and contributes overall to the national debt, which is the multi-year $27 trillion IOU bucket that we basically have for our national debt, that people continue to buy and we continue to pay the interest on, because we couldn't even begin to pay the principal on it. And so discretionary fiscal policy is when we need it, we step in, and Congress spends that money. And they spent a lot of it last year, focused on trying to help people keep their jobs and to avoid bankruptcy and to avoid being evicted. So they passed a lot of spending measures to help address those fiscal policies. Now, non-discretionary fiscal policy is kind of the automatic stabilizers, the automatic things that kick in. When someone loses their job, they apply for unemployment benefits, and Congress doesn't need to approve those things. Those are already measures that are in place with the Labor Department, with the Bureau of Labor, and so and this is mainly done on the state level, but the idea there is that all of the Bureau of Labor Statistics calculates all those unemployment numbers. And so they are working with states in order to do that. But there are automatic stabilizers in place to help people when they become unemployed. Likewise, when they fall below the poverty line and they apply for welfare. And so if they are eligible for welfare, those programs automatically kick in. The unemployment checks automatically kick in if they're eligible, and the food stamps automatically kick in. The WIC cards that you see in supermarkets automatically kick in. All of these are automatic stabilizers. Government doesn't need to pass any laws in order to make things happen. These kick in because people are finding themselves falling through the cracks, and government has set up these programs as automatic stabilizers to help in these situations, knowing that eventually people are going to end up back in this camp, and we want to make sure we have a program in place to help with it. And so that's really where the non-discretionary fiscal policy comes in. The automatic spending kicks in for unemployment benefits, for unemployment checks, for those food stamps that we were talking about. Now, with fiscal policy, we also have what's called contractionary fiscal policy and expansionary fiscal policy. So think of this, again, the car analogy here. Think of contractionary as putting on the brakes. Okay, this is when times are good. You're not going to do this when times are bad. But when times are good, and you're driving a little too fast and you're worried about that inflationary gap we talked about earlier, you want to put on the brakes to keep inflation from getting out of control. So this is where you're going to cut that government spending. You're going to increase taxes or some combination of the two in order to keep the economy from getting too hot. You don't want the economy getting too hot and inflation getting out of control. Then you got an inflationary gap. How do you solve it? It's not an easy one. So how are you going to keep those prices from getting out of control? That's the brakes. Okay. The expansionary fiscal policy is hitting the gas, and this is during recessions that you're going to see expansionary fiscal policy. You're going to see, and we saw this in March and April of last year. Congress and the president stepped in and addressed budgets and increasing government spending through this stimulus package. We saw earlier in 2017, 2018, where there were a lot of fiscal policies to cut taxes, essentially giving the economy gas. Now, some economists argued that was the wrong time to do it because you gave it too much gas, and you address concerns about, again, inflation. There's no recession there, so what are you closing? So there were some concerns about that too. But in this expansionary fiscal policy, the idea of giving it some gas is really increasing government spending and cutting taxes to help people get by, to help them keep them from falling through the cracks. And then this is usually accompanied by those automatic stabilizers we talked about before. The idea of welfare checks and or welfare food stamps and welfare programs and unemployment benefits and those sort of things in order to help people get back on their feet and help businesses get back on their feet so that they can grow and start hiring people again. So this is really critical in terms of that expansionary policy to get out of that recessionary gap that we were alluding to. So fiscal policy, in terms of what we see here, we can see that when we use discretionary fiscal policy in terms of the economy, the idea here is you can see we are at AD is moving leftward or inward. We're losing steam in terms of our real GDP. This is the recessionary gap that we see here. How are we going to solve it? And how much money are we going to need? Well, notice the MPC is 0.8. So 1 over 1 minus MPC, 1 over 0.2 is a multiplier of 5. So it looks like we're going to need $500 billion to close this gap. But remember, we don't need $500 billion. We have a multiplier of 5 with the MPC of 0.8. All we need to get again, 1 over 1 minus MPC, 1 over 1 minus 0.8, or essentially 1 over 0.2. 1 divided by 0.2 is 5. So that multiplier of 5 means that whatever money we get is going to be multiplied by 5 in order to bridge this $500 billion gap we see here. And so all we need in order to bridge that gap is $100 billion. With the multiplier of 5, we can bridge that gap So government needs to spend $100 billion in order to close this recessionary gap. That spending with the multiplier will bring us back to full employment, will encourage that full employment to grow. So you can imagine, based on the multiplier, even a multiplier of 5, if the government spends, as they did, what was it, almost $7 trillion, how much money was in the economy in terms, and is in the economy, in terms of being spent out there, the multiplier on $7 trillion, essentially, with a multiplier of 5, $35 trillion out there in the economy to help keep us from recessionary devastation through the pandemic. So we can see that was a significant amount of cash. Now they're looking at a $1.9 trillion, and that's why some people in Congress are like, well, we already threw $7 trillion at it. Do we really need to spend $2 trillion more? And the question is, well, where are you in terms of, are you one of the ones that's falling through the cracks that can barely make it, that didn't see a lot of the $35 trillion that was already out there? And that is the fiscal policy debate that Congress and the president have to have in terms of addressing this. All right, in this example, we see discretionary fiscal policy because we have AD shifting rightward. We have an MPC of 0.5. And in this model, we can see AD is shifting outward to the tune of, it looks like $100 billion versus 80. How do we close this gap? Well, the multiplier is 1 over 1 minus MPC. In this case, it's 0.5. So 1 over 0.5 is a multiplier of 2. In order to bridge this gap, and in this case, it's an inflationary gap. In order to close that gap from 80 to 100, we need $20 billion. But with a multiplier of 2, we only need $10 billion. So we are going to cut spending by $10 billion or raise taxes, some combination of the two, by $10 billion in order to do this. So cutting spending by $10 billion would get us back to full employment without that inflationary gap that we see here. And there's some really good questions in the take-home quiz study packet, as well as on the MindTap questions, that I think you'll find helpful in addressing this idea of, okay, if I have an MPC or an MPS and I have an inflationary or recessionary gap, how much do we need to spend in order to get back to full employment, to get back to long run? And using that multiplier with that gap, you can do that. And it's just simple math. It's usually always simple math in terms of how to address that. In this model, we see they're cutting taxes. And again, the idea here of cutting taxes, you have an MPC of 0.8, 1 again over 0.2, a multiplier of 5 in that respect. So if you are looking at this, and the gap that we see here is a $20 billion gap. How do you close that with a multiplier of 5? Essentially, you use $4 billion in government spending. With a multiplier of 5, that is 4 times 5 is 20. $20 billion is closing that gap. So the government only needs to spend $4 billion to close a $20 billion recessionary gap, which is what we see here. Now, how much of a tax cut would you need to close the gap? You would need it to be larger. And remember, that is usually one more than what we see there. And we can do the math and get to the $5 billion in terms of what we saw there. MPS over MPC, as you may recall. And that in that case, in order to get to that MPS over MPC, 0.2 over 0.8 simplifies to 4, a multiplier of 4 in that case for the tax multiplier. And in order to get that $20 billion gap, you would need 20 divided by 4. The multiplier would be $5 billion. So a tax cut of $5 billion would close that $20 billion gap. One thing I want to point out here that you can notice is this government spending gap is only $4 billion, but look how much more of an impact it has. That $4 billion in spending cuts can bridge that, in spending can bridge this $20 billion gap. But it takes $5 billion in tax cuts to close that gap. That's a really great example of how the tax multiplier is not as great and never will be greater than the spending multiplier. It is always better for the spending multiplier to be approached in terms of if you're trying to close a gap. It's always going to be greater in terms of addressing that. And again, that's fiscal policy. The legislators decide whether it's cutting taxes or raising taxes or cutting spending or raising spending. But the idea is the spending multiplier is always going to be greater than the tax multiplier. And if you keep that in mind, when you come to those questions, it'll make a lot more sense. There are some lags in fiscal policy, and I want to address that just briefly. The idea is Congress takes time to get a clue on what's happening with economics. There's a lag in the business cycle as it is, and then for Congress to react to it is going to take even longer. And then once it does pass, in terms of that administrative aspects of actually passing the legislation, then we get to the operational, which is sometimes the getting the checks and spending and executing that is going to be difficult too. So the operational lag is there. So sometimes taxing or cutting taxes is actually quicker than the spending in terms of getting money in the hands of people because they can spend those tax cuts right away. But again, there is a lag here, and that's important to note in fiscal policy. It does take time in order to for these things to take effect. These don't just happen overnight in terms of what they're trying to address here. Some other aspects to take a look at here. The lag that I was referring to, this is a great example of the lag that you see there in those terms in trying to address it. Another thing to keep in mind with non-discretionary fiscal policy is we have a progressive income tax system. The more you make, the more they take, right? So remember, when GDP falls, the idea is that the tax burden on consumers is going to be lower because you want to promote consumption. You want people to go out and actually spend money. You want that to encourage aggregate demand. And so that's why when GDP is falling and you're in recession or headed there in a recessionary gap, you want to ease the burden on taxes. You want to cut taxes and increase spending. You want to encourage aggregate demand because the idea there is, especially in hard times, you want to you want to keep people going out and spending money, and cutting that tax burden definitely helps them do that. Now we know with Congress that's a little harder to make happen, but because of the lag and the fact that it does take time, but it does work. Unemployment benefits, we know these are automatic stabilizers. We talked about that, social service programs like welfare, food stamps, and whatnot. But again, these programs are going to need more money when that we're in recessionary gap or when GDP is falling versus when GDP is growing. When we're at full employment or when we're in inflationary gap, you're probably not going to need a lot of unemployment benefits. You're not going to have anybody on unemployment. Only a very small few. And those that are contributing in tax dollars are going to be more beneficial in those spaces. In terms of budget deficits and surpluses, you can see with and without automatic stabilizers, there's a lot of mirroring here in terms of GDP and that growth in those growth areas, and the outlays in terms of the business cycle that we see there. The gray areas being recessionary periods in terms of what you would see there. But the idea is the same. We're going to need more help in stabilizers when times are bad, and we're going to need less help when times are good. And this definitely addresses that. Last thing to mention here is, again, one more fiscal policy practice question. If you have non-discretionary fiscal policy that's kicking in and the MPC is 0.8, what is happening here? If your aggregate demand is falling, you're in a recessionary gap, and you need to close that recessionary gap of $400 billion. Well, notice MPC is 0.8. 1 over 1 minus MPC is 1 over 0.2, which is a multiplier of 5. To close that gap, the idea here is we need to close a $400 billion gap. And in order to do that, what we're looking at here are transfer payments, the automatic stabilizers. So remember that these transfer payments are like taxes. They're always going to be less than the spending multiplier, 1 less than the spending multiplier. So in this case, instead of the multiplier being 5, the multiplier is really 4. And 4 to get to that $400 billion gap you'd need $100 billion in transfer payments as a multiplier to address here. Because again, the spending multiplier is really where you're going to see the biggest ripple effect in terms of growth. You're not going to see that as much in transfer payments or in tax cuts. Okay, now let's look at the final section as we wrap up this chapter on national income and price determination. We're going to look at economists and what they think about the economy in terms of how much or how little government should be involved. Now, the first one we're going to look at is what we call classical economic theory. This is the idea that any changes in demand won't change output because the idea is that even in the short run, you have wages and things that are very flexible. Okay. Now we know that that's not always the case, but classical economic theory says this is very self-correcting. We can solve these problems. Even sticky wages aren't really sticky. These are problems that we can solve. Okay. So notice short-run aggregate supply is essentially long-run aggregate supply in terms of the model that classical economic theorists look at here. So it's very vertical. And the idea is aggregate demand isn't going to increase unless it's causing inflation. So any increases in aggregate demand, and this is kind of the drawback, right? Any increases in aggregate demand, you're assuming that there's going to be inflation as a result of that. And that's not always true. That's not always true in terms of aggregate demand is always going to lead to those inflationary tendencies in the long run. One of the things we noticed was when aggregate demand moved outward and short-run aggregate supply also moved outward or rightward, it led to a lower price levels and greater real GDP, thus debunking the classical economic theory. But they do have some points in terms of what they're trying to address here. So the idea that they're trying to point to is because this is self-correcting, government doesn't really need to step in to resolve these problems because ultimately AD is going to shift leftward or outward or leftward or inward, and that's going to lead to lower price levels. And so ultimately it's going to solve its own problems. And so fingers crossed that will work. Now, the Great Depression is an example where classical economic theory was really put to the test, and from 1929 until almost 1933, you had classical economic theory being integrated into the work of the economy, and it wasn't working. 1 in 4 people were out of work, unemployment over 25%, and John Maynard Keynes steps in and basically says, look. This idea of the long run is really great in terms of self-correction, but in the long run, we're all dead. You can look at this classical economic theory and say, well, the economy is going to self-correct, it's going to solve its own problems, but how do you feed your family in the meantime? And this is what I was referring to earlier. How do you really say that the economy is going to fix itself when government has tools that it can use to try and address the problems of the day and put people back to work in less time and get the food on the table for their families? Why would you look at that and say, well, we should just fold our arms and sit back and let the economy do its thing, when you really could have an impact and really do something about it? So this is the Keynesian theory, or the idea of government involvement in terms of what we see here. So this is where you have a decrease in aggregate demand that is going to lead to recession, and your wages aren't flexible; they're sticky at that point. But the concern is that an increase in aggregate demand during a recession doesn't cause inflation. So what we're looking at again is this short-run aggregate supply curve that is the long run. But the idea here is an increase in aggregate demand in a recession isn't going to cause inflation, because the idea is that people we're not at full employment and people are struggling, people are suffering, and so it's less concern to worry about inflation at that point. Get people back to full employment, get people working again, get them on the job again, and that's really going to be more helpful than worry about inflation. Meanwhile, people are out of work and kids are going hungry. So the idea here is that sticky wages will prevent wages from falling, but government coming in and spending money in the economy is going to help bridge the gap in terms of that recessionary gap. And so this was not a common theme at the time. FDR definitely looked at this and talked this over with many of his economists, but he really came around to Keynes' way of thinking and really used it to promote his New Deal programs because that spending helped get people back to work. It improved consumer confidence, which shifted AD. They were going out and spending money because now they had money, now that they had jobs, and this was continuing to help grow the economy and grow them out of this depression that they were in. So even with high unemployment, they didn't have to worry about inflation at this point because they were more concerned about getting people back to work and less concerned about the problems of inflation. We'll worry about inflation when everybody has a job. We'll worry about inflation when everybody's belly is fed. And those were the concerns that they were trying to address. And it definitely did help. And it really gave a lot of credence to the Keynesian economic theory. In terms of trying to spend your way out of recessions by getting government to spend in and cut taxes, increase spending, and grow the economy by creating jobs and bringing us back to full employment. Then in better times, cut those spending measures, increase taxes in order to make up for the loss that you had, and that essentially is the economic models that we have today. So had a student one time said, so basically we can blame Keynes for the $27 trillion national debt that we have today. It was another number back then, but I said, okay, well, I guess putting two and two together, I guess that is in some sort of way, but you can also thank Keynes for all of the people that survived the Great Depression that weren't waiting, starving to death, waiting for the economy to self-correct. And the student said, yeah, true that. So there's definitely different schools of thought, but that is one to keep in mind. So it's important to note, we have this idea of looking at the aggregates, the short-run aggregate supply, or that upward sloping curve we talked about. The classical range is really looking at it from a long-run aggregate supply curve, where Keynesian Keynesian into intermediate is really looking at that upward sloping SRAS, or short-run aggregate supply curve, that we see there. And there's a bunch of explainer videos on AS and AD that I think you'll find helpful. So in short, what do we need to know about this? You just need to know that classical economic theory is the idea that the economy is going to self-correct, that if unemployment is higher, ultimately sticky wages aren't going to be sticky any longer. Workers are going to accept lower wages. We're going to get back to full employment. The economy is going to self-correct and we'll be fine. Okay. If we have an inflationary gap, then workers are going to ask for wage increases, and then wages will go up, and that's going to again self-correct. We're back to full employment, and that essentially is the classical approach. Keynes' economic theory is the idea that government needs to step in and spend money to help us get back to full employment, to help us get back to that long-run aggregate supply curve that we're aiming for, at full employment, where people have jobs, people can spend money, and the multiplier can work its magic throughout that MPC, throughout that marginal propensity to consume. A really good video that I always love to show students is the Keynes v. Hayek rap battle, and it really addresses this idea of Hayek, the idea of classical economic theory versus Keynes, and where do we end up in the long run if we don't use these models in terms of moderation. Keynes did take the approach that we needed to spend in bad times, and then we needed to dial it back in good times. We're not always good at that. Elected officials who are in charge of legislating aren't always good at raising taxes and cutting spending in good times. Who wants to be in charge of raising taxes and cutting spending? No one. And therein lies the essentially the framework for the YouTube video of the epic battle that you'll see there. There are a number of slides here that have summaries that I would encourage you to check out and take a look at, as well as key terms. I also included the key graphs on the back here that I think you'll find helpful in terms of taking you through each of the key graphs of the 4 that we have in this chapter. And I've also included explainers, explainers on aggregate supply, as well as aggregate demand, and looking at AS and AD, and as well as the multiplier effect that we talked about, that idea of the marginal propensity to consume and the marginal propensity to save. I know this was a very long chapter covering 2 weeks, but I think this was time well spent, and we covered a lot of ground. There are the answers to the take-home quiz study questions, the multiple choice portion. There's also, if you'll notice in the modules section, there's also what's called a Unit 3 sample questions. These are additional questions that I think you'll find helpful in getting ready for the summative quiz on this chapter, in terms of additional questions that you might be asked that were on the content that we covered in this video. You'll find those answers to the sample questions here. Those are also available for you on My MCPS Classroom in the modules section for this chapter and this unit. Thanks for sticking with me. I hope you found this helpful, and good luck on the upcoming assessment, the summative assessment test, and the AP exam.